Most people who think they are building a serious portfolio are not building a portfolio at all. They are building a pile of symbols, a pile of opinions, a pile of excitement, fear, headlines, and whatever happened to go up last quarter. Then one bad year arrives, one hard correction, one ugly earnings season, one regime shift in rates, one stretch where yesterday's winners stop behaving like winners, and they discover something painful. A pile has no spine. That is the idea I want to leave with you. If you want to build wealth over a decade, 2 decades, or 3, you do not begin by asking which ticker will make you feel brilliant this month. You begin by asking a much harsher question: what kind of machine am I actually building? Because that is what a real portfolio is. It is a machine. It takes your labor, your patience, your future purchasing power, and your emotional discipline, and then it converts those things into ownership. The quality of your life later on depends less on whether you guessed one hot stock correctly and more on whether the machine itself was designed to survive good markets, bad markets, stupid markets, euphoric markets, inflationary markets, and markets where everyone suddenly decides the future belongs to a different story. When I study an ETF, I am not looking for a magic ticket. I am looking for the kind of gear I would trust inside that machine, and if you do not understand that difference, you will spend years chasing returns and never build the one thing that actually creates them over time, a machine with a spine. Now, I am going to say something that sounds obvious, but most people do not live by it. Past performance is not a prophecy, it is not a promise, it is not a contract with the future, but it is evidence, and sensible people use evidence. If I am going to hold a core position for years, I want to know how it behaved when the world was kind and when the world was unkind. I want to know how deep the drawdowns felt, how quickly the recovery came, what the fee drag looked like, what kind of companies sat inside it, and whether the thing was really diversified or simply wearing a diversified costume. That is why I care about the history of an ETF. Not because history tells me what will happen next, because history tells me what kind of creature I am dealing with. And in the data I am looking at here, there are 9 ETFs that make a very interesting case study. Not because they all deserve a place in every portfolio, they do not. And not because the one with the highest 10-year number is automatically the best choice. It is not. They matter because together they show you the architecture of modern investing. They show you the tension between breadth and concentration, between cash flow and acceleration, between the comfort of owning the world and the thrill of owning the hottest corner of it. If you understand these 9, you will understand far more than 9 tickers. You will understand how money organizes itself. And that is where the real edge begins. The first mechanism in the machine is what I call the world valve. A lot of people say they want diversification, but what they really want is emotional comfort. They want to say the word diversification while still owning almost entirely the same handful of American giants everyone else owns. That is why an ETF like VEXUS is interesting. VEXUS gives you broad non-US equity exposure across developed and emerging markets, more than 8,000 companies outside the United States. In the set of numbers I am looking at, it carries a fee of 0.05% and a 10-year average annual return around 8.36%. That number will not make adrenaline addicts happy. Good adrenaline is not a portfolio strategy. VEXUS is not there to make you feel clever at cocktail parties. It is there to remind you that the United States is not the whole world, that global capital does not move in one rhythm, and that periods of U.S. underperformance do occur, even if people forget that in long bull markets led by American technology. The top holdings mentioned here include Taiwan Semiconductor, Samsung, ASML, and Tencent. That alone should tell you something. The world valve is not just about geography, it is about admitting that innovation, manufacturing strength, capital discipline, and strategic importance can exist outside your own flag. Now, a lot of investors do not want to manage separate buckets. They want one instrument, one global wrapper, one decision that says, I own the market system, rather than a national story. That is where VT enters the conversation. VT is the whole world cousin, more than 9,000 stocks across the globe in one fund, a fee around 0.06%, a 10-year average annual return in this material of about 11.93%. And here is the lesson hidden inside that number. When people say world exposure, they often imagine they are escaping concentration. Not entirely. The market is still market cap weighted. The largest enterprises on earth occupy the largest share of the fund. So yes, Vermont gives you the globe. But the globe itself is dominated by the biggest corporate winners, many of which still sit in the United States. That is why the top holdings here still include names like Nvidia, Apple, Microsoft, and Amazon. That is not a flaw. It is the map. And if you do not understand that map, you can think you are buying one kind of diversification when you are really buying another. The second mechanism in the machine is what I call the cash flow floor. This is where SHD earns respect. I have always found it amusing that people will dismiss dividend-oriented funds as boring and then spend their lives searching for financial freedom. Nothing about freedom is anti-boring. Freedom often comes from repeating a few intelligent things for a very long time. SAC tracks a dividend-focused basket of 100 quality U.S. companies with sustainable dividend growth. In the numbers here, it has about $71 billion under management, a fee of 0.06%, and a 10-year average. Total return around 12.23%. Read that number again, 12.23%, not with the glamour of a semiconductor mania, not with the noise of a speculative boom, with cash flow, discipline, and lower volatility characteristics than the more aggressive growth funds people worship. That is why I call it the cash flow floor. A floor does not impress anybody until the room shakes. Then suddenly everyone understands why floors matter. Its major holdings in this material include Chevron, ConocoPhillips, Merck, and Verizon. Mature businesses, essential businesses, businesses that are not built on the assumption that every future dream will arrive on schedule. If your machine has no floor, one sharp cycle can turn your confidence into liquidation. And if your machine has only a floor, you may protect too much and build too slowly. That is the game. Not finding a single perfect answer, balancing the machine. The third mechanism is the American engine. This is where the argument between VTI and VOO lives. And a lot of people waste energy pretending that this argument is bigger than it is. VTI is the total U.S. stock market. It gives you the big companies, the mid-caps, and a measure of small-cap participation. In the figures I am looking at, it carries a microscopic fee of 0.03%, more than $500 billion under management, and a 10-year average return around 14.66%. That is an exceptional long-run number for something this broad. What VTI says is simple. I want America as an ecosystem. I want the established giants. But I also want the smaller organisms that might become tomorrow's giants. I want the whole field, not just the brightest stadium lights. Then you have VOO, the SP 500, the polished version of American corporate power, also a fee around 0.03%, even larger in assets, a 10-year average return here of about 15.26%, slightly above VTI in the same period. Why might that happen? Because the SP 500 is ruthless. It is not sentimental. Companies that stop deserving their place eventually lose it. Stronger ones replace them. It is a quality filter disguised as a broad market benchmark. The top holdings, again, are the now familiar giants. Nvidia, Apple, Microsoft, Amazon. Now listen carefully, because this is where amateurs become adults. The difference between VTI and VOO is real, but it is not the difference between wisdom and foolishness. It is the difference between two intelligent expressions of the same national belief. If you choose VTI, you are saying, I want the full American organism. If you choose V, you are saying, I want the strongest listed muscle inside that organism. Neither answer is insane. What is insane is not knowing what question you are answering. The fourth mechanism is what I call the winner's gear. Now we enter more dangerous territory because once people hear the word momentum, their eyes light up for the wrong reason. They think momentum means easy money. Number momentum means you are systematically leaning into what has already proven strong price behavior. And accepting that leadership changes will force reconstitution. That is what SMEMO represents. This fund targets 100 stocks within the SP 500 that have exhibited the strongest price trends over the prior year. In the numbers here, it has about $13 billion under management, a fee of 0.13%, and a 10-year average return around 18.51%. That is not a small improvement over the broad market. That is a serious difference. But serious differences come with serious conditions. A winner's gear works because markets trend. It works because capital crowds into strength, because institutions chase improving narratives, because money prefers evidence to hope when things are functioning. Well, its large positions in this snapshot include Nvidia, Broadcom, Johnson & Johnson, and Micron. Notice what that tells you. Momentum is not just tech mania. It is a ranking process. It is leadership capture. The danger is emotional. People see a high 10-year return and decide they have discovered a shortcut. Then they size it like a religion and panic at the exact moment the gear rotates. A gear is useful because it meshes with the machine. A gear becomes destructive when you mistake it for the whole machine. The fifth mechanism is what I call the innovation lane. This is where QQ earns its following. The NASDAQ 100 has become, for many investors, shorthand for future. Facing American growth, large non-financial companies, heavily tilted toward technology and communication services, built around scale, software, chips, cloud devices, and the systems that increasingly mediate modern life. In this material, QQ carries a fee around 0.18% and a 10-year average annual return of about 20.32%. That is an extraordinary number. And extraordinary numbers create extraordinary delusions. People begin to think returns like that are normal. They are not normal. They are the compensation for living through concentration, volatility, valuation risk, and periods where everybody suddenly decides the future has been overhyped. But if you understand that, QQQ becomes extremely useful. Not because it promises comfort, because it concentrates on the kinds of enterprises that have absorbed a growing share of the economic value created in the digital era. Its top holdings again include Nvidia, Apple, Microsoft, and Amazon. You do not need me to tell you, those are powerful businesses. The question is whether your machine needs more innovation torque, and if so, how much volatility you can survive without behaving like a fool. That brings me to the sixth mechanism, the pure technology rail. This is VGT. Now we are no longer talking about broad growth with a major tech tilt. We are talking about a structural bet on the technology sector itself. Software, hardware, semiconductors, the infrastructure of digital progress. In the figures here, VGT carries a fee of 0.09% and a 10-year average return around 22.96%, nearly 23% a year on average across a decade. That is the kind of number that changes family trees. It is also the kind of number that seduces people into forgetting risk. VGT is not a neutral tool. It is a rail pointed toward one section of the future. If that section keeps compounding, you look brilliant. If regulation, valuation compression, sector rotation, or technological disappointment hits at the wrong moment, you discover that high returns do not eliminate pain. They often demand more of it. The major positions here include Nvidia, Apple, Microsoft, and Broadcom. That tells you exactly what kind of bet you are making. This is not a timid bet on the existence of markets. It is a focused bet on the architecture of the digital economy. The seventh mechanism is the silicon spine. And this is where SMH becomes impossible to ignore. Semiconductors are not a side story anymore. They are the picks and shovels, the pipes and valves, the electrical pulse of modern industry, artificial intelligence, cloud computing, defense systems, smartphones, cars, industrial automation, medical devices, data centers. You can dress up the conversation any way you like, but under the costume you still find chips. SMH focuses on the largest and most liquid semiconductor companies. In the material in front of me, it has the highest fee of the group at 0.35% and also the most dramatic 10-year average return at about 33.27%. 33.27%. You do not stumble into a number like that by accident. You also do not get a number like that without living through violent cyclicality. Concentration, technology hype, geopolitical risk, supply, chain issues, and valuation surges that make disciplined people uncomfortable. Its top holdings here include Nvidia, Taiwan Semiconductor, Broadcom, and ASML. Those are not trivial enterprises. Those are strategic choke points. And that is exactly why the silicon spine is so powerful. If semiconductors are the spine of the digital age, then owning them has been one of the most lucrative expressions of modern industrial reality. But I want you to hear me very clearly. A spine is vital. A portfolio made only of spines is a monster. The reason concentrated sector funds work so well for some investors and destroy others has nothing to do with intelligence. It has to do with whether the investor understands function. Now let me show you the deeper lesson hidden underneath these return tables, because this is where money stops being random. Most of these funds overlap. That is not a minor detail. It is the detail. Nvidia appears again and again. Apple appears again and again. Microsoft appears again and again. Amazon appears again and again. Broadcom keeps surfacing. Taiwan Semiconductor and ASML emerge, where the semiconductor story gets more direct. That means a lot of people who think they are diversified are actually owning the same leadership through different wrappers. This is one of the great illusions of modern portfolios. More tickers can still mean the same bet. You can own VOO, QQQ, VGT, and SMH and tell yourself you built 4 distinct castles. In truth, you may have built one kingdom with 4 gates. That can be fine. It can even be brilliant, but only if you know that is what you are doing. Because when the same leadership that powered all 4 gates stumbles, you do not want to discover your diversification was a costume worn by concentration. This is why I keep returning to the machine. A machine builder does not ask which ETF is hottest. He asks what job each gear is doing. Is this fund my world valve? Is it my cash flow floor? Is it my American engine? Is it my winner? S gear? Is it my innovation lane? Is it my technology rail? Is it my silicon spine? Those are engineering questions, and engineering beats excitement. Now I want to address the phrase that pulls people into these conversations in the first place. Better than VOO. I understand why people love that phrase. It is dramatic, it is clickable. It makes investing sound like a tournament. But here is the adult answer. Better for what? Better for whom? Better under what conditions? Better across what emotional constraints? Better with what time horizon? If you are 28 years old, still accumulating aggressively, comfortable with volatility, still earning and psychologically capable of watching technology heavy funds fall without touching them, then there are funds in this group that may well outpace VOO for long stretches. If you are 65, drawing income, trying to preserve a lifetime of work, sleeping poorly during corrections, and depending on your portfolio to fund living expenses, then better than VOO may be a phrase that leads you directly into a mistake. A man who needs stability should not worship the same statistic as a man who still has 30 years of earnings ahead of him. That is not cowardice. That is matching the machine to the mission. The eighth mechanism, then, is not an ETF at all. It is what I call the mission filter. And without it, every table of returns becomes dangerous. The mission filter asks whether the portfolio's design matches the life it is supposed to support. A lot of investors skip this because it is less fun than comparing performance, but it is the most profitable question in the room. If your goal is to build a simple, hard-to-sabotage core, the mission filter may push you towards something like VOO Vermont I or VT as the structural center. If your goal is to add cash flow behavior and some ballast, the mission filter may create room for SHGD. If your goal is to express a conviction about innovation or semiconductors without pretending you can pick the single winning stock, then QQQ, VGT, SBMO, or SMH may belong in smaller, consciously chosen slots. If your goal is to avoid a purely U.S.-centered life raft, then VEXUS or VT becomes more meaningful. You see the difference. The machine is not built from hype. It is built from purpose. And that brings me to the identity flip, which most people never make. Most investors live as return. Chasers, they open an app and ask, what is up the most? They hear a story and ask, what am I missing? They read a chart and ask, how do I catch up? That identity never builds durable wealth. It may produce moments of excitement. It may even produce one lucky stretch, but it does not create repeatable compounding because it is reactive at the root. The richer identity is the machine builder. The machine builder asks, what am I trying to own? What kind of cash generation, innovation exposure, global breadth, and emotional durability do I actually need? Where is my core? Where is my tilt? Where is my concentration? Where is my risk budget? Where is my blind spot? That is a completely different psychology. One person chases outcomes, the other person designs systems. One person feels smart when a position runs, the other person feels calm when the machine keeps working. And I will tell you this from experience, calm compounds better than excitement. Now, once you accept that truth, the blueprint becomes clearer. If I were speaking to a young investor who wanted a practical operating system rather than a pile of opinions, I would tell him to think in layers. The first layer is the ownership core. This is the layer that should still make sense. If you got busy, got sick, got distracted, had children, changed jobs, moved countries, or simply lost interest in reading market commentary every night, that core is where broad market funds earn their keep. Something like VOO Vermont I. Or VT can live here because they make fewer assumptions about your ability to forecast the future. They let capitalism do more of the lifting. The second layer is the reinforcement layer. This is where you decide what kind of reinforcement the machine needs. Maybe it needs global breadth beyond the U.S. Maybe that points you toward VEXUS. Maybe it needs cash flow behavior and quality dividends. Maybe that points you towards HED. This layer exists to correct what the core lacks. The third layer is the conviction layer. This is the layer most people start with, which is why most people build unstable portfolios. Conviction belongs on top of structure, not in place of it. This is where you might use QQQ, VGT, SBMO, or SMH. Not because you are trying to gamble your way into an identity, because you have a reasoned view that certain kinds of leadership may deserve a measured overweight. Measured is the important word. If a conviction layer becomes so large that it can wreck your behavior, then it is no longer conviction. It is vanity, and vanity is expensive. The fourth layer is the behavior rule. No machine survives bad behavior. You do not need a genius rule here. You need a usable one. You decide how often money goes in. You decide what happens when the market falls. You decide whether you rebalance on a schedule or only with new contributions. You decide in advance whether headlines get a vote. If you do not decide these things in calm weather, fear will decide them for you in a storm, and fear is a terrible portfolio manager. Let me say one more thing about fees, because people love to ignore small numbers until small numbers compound into large theft. Look across this group and you see a lesson. VEXUS at 0.05%, VT at 0.06%, SAG at 0.06%, VTI and VO at 0.03%, VGT at 0.09%, SMO at 0.13%, QQQ at 0.18%, SMH at 0.35%. Fees are not the whole story. A higher fee fund can still outperform dramatically if it sits on a powerful trend, as SMH clearly did in this period. But a higher fee is always a hurdle, and sensible investors respect hurdles. You do not pay more unless you know what extra exposure or structure you are buying. Otherwise, you are simply donating performance. The same is true of narrative. You are not paid because a story feels exciting. You are paid if the exposure proves useful over time. That is why a 10-year lens matters. Anybody can look brilliant for a year. A decade is where noise begins to lose oxygen. Now, if you are listening to me carefully, you may notice that I have not told you which one is best. That is deliberate, because I do not want you to leave this story thinking wealth is built by memorizing somebody else's ranking. Wealth is built when you learn to ask better questions than the crowd. The crowd asks what beat VOO. The better question is, what kind of machine do I need to still trust when the cycle turns? The crowd asks which ETF returned the most. The better question is, which combination can I keep funding, keep holding, and keep understanding when boredom, greed, and fear start taking turns at the wheel? The crowd asks, what should I buy today? The better question is, what will I still be glad I owned after a bad year, after a hot year, after a flat year, and after the next narrative replaces this one? Those are adult questions, build adult money. And that is why history really does repeat in markets, though not in the lazy way people mean it. It repeats because human nature repeats. People crowd into winners, people underprice boring quality, people mistake overlap for diversification, people discover concentration only after it hurts. People worship recent returns, people abandon structure when excitement enters the room. And every generation thinks it discovered a new way to ignore the old rules. The old rules remain: own productive assets. Keep costs low unless you know what you are paying for. Do not confuse a wrapper with a philosophy. Do not let your emotions outrank your system. Let breadth do some of the work. Let conviction do only the work it is qualified to do. And above all, build a machine you can stay inside, because the great secret is not that the best ETF of the decade made the most money. The great secret is that the investor who stayed inside a sound machine for the whole decade usually beat the investor who kept jumping from one shiny story to the next. That is how fortunes are actually built, not by brilliance every quarter, by coherence over time. So here is the final test I would leave you with. If the market opened tomorrow and every financial personality in the world started arguing about whether semiconductors were overowned, whether AI was a bubble, whether international stocks were finally ready to lead, whether dividends were dead money, whether momentum had broken, whether America had become too concentrated, whether gold should be in every portfolio, and whether the next decade would look nothing like the last one, what would you do? If your answer is that you would panic, chase, rotate, improvise, and start shopping for a new identity, then you do not yet have a machine. You have a pile. If your answer is that you would review your mission, inspect your layers, add capital according to your rules, and let your design do what it was built to do, then you have crossed the line that matters. You are no longer just buying ETFs. You are building wealth on purpose. And once you learn to do that, you stop asking whether something is merely better than VOO. You start asking whether it deserves a place in the machine that will carry your life. That is a much richer question, and in the long run, richer questions tend to produce richer people.